is a lot of risk when investing in the marketplace. All investments have some sort of risk, and it's really important to know your client's risk tolerance before you make any recommendations to them in terms of investing. We're going to go through each of the types of risks that are affiliated with investments so that you really understand what to avoid and what your client might be comfortable with. So we're going to start off with inflation risk. And inflation risk is really the easiest one, probably one that you've heard of very often. And it's all about purchasing power. So it's not about how much money you currently have, but rather how much you can buy with that money. So you might have a lot of money, but what can you actually buy with it? As inflation increases, the cost of goods also increase, as well as services. And so it's important that your money is growing at a rate that is higher than inflation. Inflation is measured by the CPI, or the Consumer Price Index, and it's compounded annually. So you might hear in the news that CPI says that it's 2%. Now that doesn't sound a lot, but because it is compounded annually, that can accumulate to be quite significant. And it can erode the purchasing power of your money. And so what is most affected by inflation rate risk? It's really those fixed income securities like cash, bonds, GICs, the money market, and annuities. And the reason that these types of investments hold the highest risk in this category is because there is a set amount of money that you're receiving. So for example, in an annuity, every month you're getting, let's say, $3,000 a month for a set period of time, perhaps the rest of your life. That money does not increase with inflation. And so as a result, the $3,000 remains $3,000. What you could buy 5, 10, 15 years ago with $3,000 is certainly not the same as what you can buy today. And the same is true of the future. So what we can buy with $3,000 today is not going to be true in the future. We won't be able to buy as much in terms of goods and services. And so that is what inflation risk is really all about. That money that you're receiving is really losing its purchasing power. The next one that we're going to go through is interest rate. So interest rate risk also most affected those same fixed income securities, cash, bonds, GICs, money market, and annuities. And the reason that they are most effective is because the interest rate is tied to the investment and will not change. So if the market changes, the interest rate in those specific income annuities, it doesn't change, it remains the same. So if you're getting 2%, it remains 2% even if inflation increases. And so if the interest rates in the market increase and everybody else is getting 5%, but you're only getting 2%, you're really losing out. And so that's a significant loss. You're stuck with that investment and you can't do anything. So one thing to remember is that with bonds, specifically as interest rates go up, bond rates go down, and they have an inverse relationship. So as interest rates go down, bond rates go up. Market risk. So market risk is associated with stocks and bonds, and market risk is really about a systemic risk or a systemic loss, and this means that there's something in the system that has essentially failed or crashed, and so this affects everything that's happening in the stocks and bond market. Examples of this would be a total market decline as a result of economic recession. So back in the 2008, 2009, that market collapsed. You saw everything sort of crash. A lot of people really lost a lot of money. Natural disasters, so these are outside of our control. Natural disasters like hurricanes, all of these types of things that are becoming more and more common actually do affect the market as well. And last but not least, terrorist attacks. Terrorist attacks surprisingly also do affect the market and can make significant changes to the market. So these are all classified as a systemic risk and primarily associated with stocks and bonds. Loss of capital. Loss of capital is about when you invest your money into into something that you can't get it out. And really the main one that falls under this category are annuities. So a life annuity, you can't cash it out. A straight life annuity with no guarantees, the company does not continue those payments past 1 month when the beneficiary dies. So let's say, for example, your client sets up a life annuity with no guarantees. They put in $10,000 into that annuity and they're receiving their payments. And after 2 to 3 years, they pass away. There are no guarantees put onto this life annuity, and so those payments stop. Any money or any capital that was initially invested, nobody receives that back, and so the insurance company is within their rights in the contract to keep that capital. And the way to sort of avoid some of this potential risk is to put together a joint life annuity. So the joint life annuity, there is a little bit of protection because when one beneficiary passes away, the spouse, typically the spouse in a joint annuity, can take over, will continue to receive those payments. However, when both people pass away in a joint annuity, the money or that capital is still lost. Guarantees are a way that can protect against some loss, but really not all loss. Typically, guarantees are not available for the entire life of annuity, and they can be expensive. But they are really important because if you do pass away during that guarantee period, the money is not lost and you do receive that capital back. Credit risk, which is also known as default risk, is when companies or countries or really somebody who is making a financial obligation cannot meet that obligation at the time of maturity. So let's say, for example, this is primarily associated with bonds. So remember, with a bond, you are loaning a company or a country money, and at the time of maturity, you receive that money back. And the credit risk or default risk is when that company or country do not have the money to repay that loan or bond. And so we have something called rating agencies who assess the risk of a company. So for example, like Moody's. What they do is they rate the bonds from the companies or countries on a scale of AAA to C. And now, of course, AAA being the best possible bond you can invest in, and C being junk. And actually, they are known in the industry as junk bonds. One example of a junk bond or a country that's been classified as distributing C bonds is actually Venezuela. Currently, they're defaulting on their loans, and so they have been ranked by the rating agencies as C or junk bonds. Foreign exchange risk, which is actually also called currency risk, is about the difference of value in money when it's converted back to your local currency. So often people are investing in currencies in other countries. That currency might hold a lot of purchasing power in that country, but when it's converted back to your local currency, it might not be able to purchase as much. One great example of this is the US dollar to Canadian dollar. So if you take the US dollar to Canada, or you bring the US dollar to Canada, you really do make a lot of money. Your Canadian dollar is worth around right now, around 1.3, I believe, of a US dollar. So you are making a lot of money. Your purchasing power is increased. However, if you take the Canadian dollar to the US market, you're actually losing purchasing power. You're losing about 30 to 40% of your investment. And so that is a really good example of foreign exchange risk, that there is a high risk that you could lose a lot of money when you're doing those sort of conversions. The easiest way to understand liquidity risk is to answer a really simple question. Can the asset or investment be converted into cash quickly? So basically, can your client access those funds in the event of an emergency? If it takes under 30 days in order to access those funds, the investment or the asset is considered liquid. Around 60 days is considered medium, and anything longer than 90 days is considered illiquid. Liquidity risk is associated with not being able to convert your asset into money or cash when needed. So an example of liquidity risk, or something that holds liquidity risk, would be real estate. Real estate is considered an illiquid investment, and that's because in order to sell it, you do need a buyer, and that could take a long time in order to find one. There are also increases in time associated with closing dates and getting money and all of those kinds of things. So real estate is a great example. Another really good one is annuities. Once you invest your money, or you hand over that lump sum of cash for the annuity, you cannot access the funds. So once you do that, you're sort of stuck in that investment and you can't get that money out. Illiquidity risks are really associated with longer term investments. And so if your client is comfortable investing their money for a longer period of time, then they should be more comfortable with a liquidity risk. But if they are not, then these types of investments are really something that you should avoid for your client. The last type of risk that we're going to go through is industry risk. There are two causes of industry risk: consumer indifference, or strikes or labor unrest. So consumer indifference, what is that talking about? There are specific industries or specific companies that there might not be a market for the product or service that they are selling or providing. And that could be because the government is no longer supporting or investing that industry or that company, or perhaps buyers just don't want to be associated with that product, whether it be cultural, religious, moral, maybe they feel like they're not getting great customer service. Either way, the customer is no longer interested in the product or service that's being provided. A great example of this is Sears. Sears was doing really well for a lot of years, been in Canada for many, many years, but more recently there has been a lot of consumer indifference towards the company, and so it has most recently had to shut down and close its doors. The other thing associated with industry risk, strikes, and labor unrest. So when during this period at a company, nobody is working or producing products. Meanwhile, expenses continue to accumulate, and unfortunately, usually a company cannot recover in this type of situation. If your client is worried about this strikes or labor unrest, it's important to stay away from unionized labor, because these are the workers who are able to strike and do so more often. That's all we're going to go through for risk. If you have any more questions or you would like some more detail, please refer to your study notes.